I'm Jim Zubak, and welcome to my YouTube video for Wednesday, May 24th. I know that most people don't know that I'm a baseball fan because I really disguise it. But the Orioles and the Yankees, who are the two hottest teams in baseball for the last 10 days, are meeting for a 6-game series with number 2 in the American League East at stake. They're currently 2-3 behind the Rays. So it should be an interesting stretch of time. And I'm going out to the game on Thursday, and I'll wave to you. I'll be in the bleachers. So if you see me waving to you, that's who I am. Okay, if you like this video, please give it a thumbs up. Subscribe to my YouTube channel. That way you'll get notification. We know when we're doing them. You'll get notification of when we do our next one. We do about 3 a week, not always on the same day. It's free. You can get more of my stuff, also free. 3 portfolios, a couple posts a day on my free site, that's jubakpicks.com. Or you can go for 6 portfolios, more posts a day, some options, some ETFs. That's on my paid site, jubakam.com. You can find links to all those down below. Okay, today's topic. And, you know, if we didn't have Yiddish, I don't know what we would do in English. But today's topic is, Oi, Gevalt! Is this any way to run an economy? The answer to that is no, it's not. Okay, we all know that there is a looming debt ceiling crisis. The government runs out of money in early June. The risk of default is very, very pressing. This is, after all, May 24th. On June 1st, Treasury is saying that there's a good possibility that Medicare payments to providers, it's not to recipients of Medicare, but to providers, of about $47 billion, not enough money in the bank to pay them, and also about $10 billion worth of military pay and retirement. That's on the 1st of June. On the 2nd, the posterior really hits the rotating blades because there's $25 billion in Social Security money that's supposed to go out, which doesn't exist in the Treasury at the moment. So this is really down to the wire. But on the other hand, the market doesn't seem to be terribly worried. Here's a chart of the VIX, otherwise known as the fear index. You note that we're bumping along down here. We're 17, 18. The long-term trend on the VIX for 5 years is sort of like 17 is the low level. So you see we're not getting any fear. Here's back when we were really afraid, and we were at 24, 26. Haven't done anything since. The market just thinks that this is all going to be, that the debt ceiling is not a real crisis, and it's not. It's a manufactured crisis. It's a political crisis rather than anything else. This will all be resolved, and the U.S. really won't go into default. There's no pricing here for a default, which would have some rather large impact on the stock market. But, and here's the thing that leads me to say, Oi, Gevalt. After the debt ceiling kerfluffle is over and we start to really pay attention to it, we hit a number of things, which is that the Treasury, for example, needs to rebuild its cash balances. If you draw cash balances down to zero because you can't raise any money in the debt markets, you got to rebuild them. The Treasury usually sits on about $500 billion of cash, so it has money to pay its bills when they come due, as opposed to having to wait until tax revenue comes in. So they have to rebuild that. So we're looking at about $500 billion of Treasury sales immediately after there's a deal. And that, of course, means that there'll be a lot more supply on the market, which means that to get people to buy them, to get investors to buy them, interest rates, coupon rates on those will have to go up. But also, more importantly, because this is about the economy, not just the financial markets, taking $500 billion out of people's pockets and putting it in the Treasury amounts to shrinking the money supply. It is a liquidity crunch. And if the Fed right now is sitting there worried about, well, maybe we've gone too far, they're looking at the possibility of seeing $500 billion come out of the economy, coming out of the money side really, really quickly. That's a worry, a concern. We've got a June 14th meeting coming up. There's also the fact that we've gone completely backwards on Keynesian understanding of the business cycle. Now, Economics is called the dark science because it's not really a science, but we do know certain things. And thanks to John Maynard Keynes and the Depression, we know that when you go into an economic slowdown, you're supposed to spend more. And when you have economic boom times, you're supposed to take money out of the economy and the money supply so that you don't get runaway inflation. The problem is that over the last 20 years, maybe more, we've gotten it really backwards. So what we're looking at right now is a situation where everybody thinks the economy is slowing, but we're also looking at taking a big hit to liquidity from the Treasury bond sales, as well as reducing spending. I mean, that's what the talks and of the debt ceiling are all about. How much are we going to cut spending? I think the deal that's going to come out of that is going to leave spending sort of capped at current levels, but that means it won't rise with inflation, or maybe it will rise with inflation, but it's not going to be stimulative as we go into a possible recession backwards. Because after all, we put money into the economy when it was booming through tax cuts, and we've done that really twice under Trump and Bush, and it's all backwards. So that's why I'm sort of, it's very hard for me to figure out what the Fed is going to do given all of these, what should we say, backwards problems. And it's a very complicated situation. It makes it very hard to say, well, this is what you ought to do with your money right now. But if on one level I would say, hey, you can get 5% on short-term money, I would certainly go ahead and do that. If you can get a 5% CD or 5% on a 6 or 12-month treasury, go ahead and do that. I wouldn't necessarily put it in bond funds because the fluctuation of treasury prices is potentially pretty severe. Should you wait and maybe see whether after the treasury starts to refund, short-term rates go higher? I'd say, yeah, that would be a good time too, but we can't predict that. Is the Fed going to say, hey, we're done raising rates at the June meeting? Or are they going to say, hey, we're done raising rates for June, but we might do it later, which a number of Fed governors have said, let's not close off that possibility. It's a time of really, really high uncertainty because it's very hard to figure out what to do with your money. I would look for, in the short term, what I would look for is opportunities where things seem to be mispriced because of fear, mismanagement, the economy going, boo! I take a highly technical term. So watch very carefully. If you've got some cash, you might find some place to put it right now, but I certainly wouldn't go out there taking risk. Oh, and the last thing, not only is the market not responding with fear, the market is actually responding as if this is a buying opportunity. We're seeing huge amounts of money go into equities and equity funds over the last week or so. And it looks very much like traders are setting up to see a successful debt ceiling deal push the S&P above 4,200, which is sort of like been the ceiling recently, and then we get a bigger rally. Interesting thought. I would also just have one word for that, September, which is when anything that we don't solve in the debt ceiling in May and June comes back to bite us in the budget arguments, which probably will lead to at least a threat and the good possibility of a government shutdown in October. That's the cheery thought this morning. Let's go out and watch some baseball in the sunshine. If you like this video, please give it a thumbs up. Subscribe to my YouTube channel. That way you get notification when we do our next one. We're doing about 3 a week. If you want more of my stuff, you can go to my free site. That's gbecpicks.com. 3 portfolios for 12 to 18 months, 5-year and dividends. And as I say, it's free. That's gbecpicks.com. My paid portfolio, gbecam.com, has 6 portfolios, and there we do some options, some ETFs, and some shorting of the stock market. So links to all those down below. Thanks for listening.